Welcome back to Talk Tickers, the show for the institutional greed investor, or, at least the retail investor who wants to think like one.
Hey, exactly.
Today, we are breaking down a situation that I think drives most normal people absolutely crazy. You have a company that reports earnings, they beat expectations on sales, they beat on profit, they raise their outlook for the hottest sector on the planet, AI, and the stock
Drops. It is the classic Wall Street paradox. If you were watching the tape this morning, January 21st, 2026, you witnessed a textbook example of good news is bad news.
We are talking about TE Connectivity, ticker symbol TEL. They reported their Q1 fiscal 2026 numbers this morning, and on the surface, this looks like a slam dunk quarter.
Absolutely.
But the market treated it like a miss. The stock popped pre-market, looked like it was going to run, and then just faded all day to close down roughly 1% at $231.
Yep.
So the mission for today is pretty simple. I want to know if the market is broken or if we are missing something in the fine print.
The market isn't broken, but it is definitely cynical. What we saw today was a scenario we call priced for perfection.
Priced for perfection. That sounds like a polite way of saying the stock was too expensive.
In a way, yes. You have to look at the context. Before this earnings print, TE Connectivity stock was up about 55% over the last year.
55%.
Right. It crushed the S&P 500. It even crushed a lot of pure play tech stocks. When you have a run like that, the expectations shift. The official analyst estimates, the ones you see on a Bloomberg terminal, aren't the real bar anymore.
You're talking about whisper numbers.
Exactly. Let's define that because it matters. The whisper number is what the big hedge funds and institutional desks actually expect. Privately. It's the informal consensus.
And clearly, the whisper number for TE Connectivity was sky high.
It had to be. So even though they beat the official estimates, they likely only met the whisper. And in this environment, meeting expectations isn't enough to keep a 55% rally going. It triggers a liquidity event.
A liquidity event.
Traders take their profits, they sell the news, the easy money has been made, so they cash out and look for the next trade.
Okay, so the price action is a game of poker. But let's strip away the stock price for a second and look at the actual business. Because if the stock is down on good news, that might be an opportunity for the rest of us who aren't day trading.
Right. What did the raw data actually look like?
Exactly.
The raw data was stellar. Let's start with the bottom line. Adjusted earnings per share EPS came in at $2.72.
And what was the street expecting officially?
$2.55. So that is a nearly 7% beat. And if you zoom out and look year over year, their earnings are up 33%.
33%. For an industrial company, we aren't talking about a software startup here. That's massive.
It is.
That is significant. But I always worry that earnings can be manipulated. You can cut costs, fire people, buy back shares. Was the revenue actually growing? Or was this just financial engineering?
It was real growth. Revenue hit $4.67 billion. That beat estimates by about $140 million. That is 22% reported growth.
22%. But hold on, I know they have been buying other companies. How much of that is just them acquiring revenue versus actually selling more stuff?
That is the right question. You always want to look at organic growth stripping out acquisitions and currency fluctuations. Even organically, they were up 15%. That tells you they're actually shipping more units, selling more product. It is real demand.
Okay, so they are selling more and they are making more profit per share. I want to talk about margins because in this inflationary environment, and we will get to inflation later, margins are usually where things fall apart.
And this is arguably the most impressive part of the report. Adjusted operating margin hit 22.2%. That is an expansion of 180 basis points year over year.
For those listening who might not speak finance, bro, can you unpack 180 basis points? Why does that matter?
Sure. A basis point is 1/100%. So 180 basis points is 1.8%. That might sound small, but when you are dealing with nearly $5 billion in revenue, improving your profit margin by almost 2% is huge.
And it demonstrates what they call operating leverage.
Exactly. Operating leverage.
Yeah.
I hear that term thrown around constantly. What does it actually mean in the context of a factory?
Well, think about it this way. You have a factory. You have to pay for the lights, the machines, and the manager, whether you make one widget or a million widgets. Those are fixed costs.
Right.
Once you cover those costs, every additional widget you sell is almost pure profit.
So TE Connectivity is selling so much more volume that their fixed costs are becoming a smaller percentage of the total. So revenue goes up 15%, but profit goes up 30%. That is operating leverage.
And are they keeping that cash? Or is it disappearing into a black hole?
They generated $608 million in free cash flow. And true to form, they gave essentially all of it back to shareholders. $615 million went out the door in buybacks and dividends.
So beat on sales, beat on earnings, margins up, cash returned. It sounds perfect. So why did the stock close down? We established the whisper number thing, but was there anything in the guidance that spooked people?
There were some nuances. They guided for Q2 sales around $4.7 billion and EPS around $2.65. That is still 20% earnings growth year over year.
So it is a beat and raise scenario.
It is, but again, the market is pivoting on how it views this company.
What do you mean pivoting?
TE is successfully rebranding itself. For a decade, this was a cyclical industrial stock. You bought it when the economy was booming and you sold it when the economy slowed down.
Right.
But now they are telling a new story. They are saying we aren't just industrial. We are tech. We are AI. We are electrification.
And the market bought that story, considering the stock is up 55%.
They bought it. But now TE has to earn into that valuation every single quarter. They cannot stumble. Let's dig into the segments, because that is where the real story is.
Right. Let's talk about the elephant in the room. AI. It seems to be the magic word that moves markets right now. TE makes connectors and sensors. How exactly do they play into artificial intelligence? I thought that was just chips and software.
Not at all. They're the plumbing of AI. You can have the fastest NVIDIA chips in the world, but if you can't connect them together and move the data between them at light speed without the signal degrading, the chip is useless.
So this is their digital data networks segment, or DDN.
That's the one.
Yeah.
And how did that segment perform?
How did it do?
It grew 70% year over year.
7-0.
7-0. That is legitimate hypergrowth. That is software-level growth inside a hardware wrapper.
Wow.
And management did just pat themselves on the back. They raised the bar.
Yeah.
They explicitly increased their fiscal 2026 outlook for AI revenue by $200 million.
Wait, didn't they just have an investor day like 90 days ago?
Yes. And that is what is so crazy. In just 3 months, the demand signal got so much stronger that they had to revise their forecast up by $200 million. They are now tracking for $3 billion in AI revenue out a couple of years.
But is this just them riding NVIDIA's coattails? Is it all one customer? Because if NVIDIA sneezes, TE catches a cold.
That was a major concern, but they addressed it on the call. They clarified that the growth is broad-based across all hyperscalers.
Let's pause on that term, hyperscalers. We hear it all the time. Who are we actually talking about?
These are the giants of the cloud infrastructure.
Mm-hmm.
We are talking about Microsoft Azure, Amazon AWS, Google Cloud, Meta, the companies that are building data centers the size of small cities.
So TE is saying we aren't just selling to one of them, we are the connectivity standard for all of them.
Exactly. That's a much safer position to be in.
But scaling that fast must be expensive. Are they burning cash to build these factories?
They are spending money, yes. They announced capital expenditures and moving up to about 6% of sales. Historically, they run leaner than that.
Is that a red flag? Spending more money usually hurts cash flow in the short term. Why shouldn't I be worried about my dividend?
It is a drag on short-term cash, sure. But in this context, it is a bullish signal. You don't spend hundreds of millions on new tooling and capacity unless the orders are locked in.
So they're basically telling us, we have so much demand coming down the pipe, we physically cannot build it fast enough without expanding?
Exactly. They are funding specific tooling for AI program ramps.
So the AI story is real, but AI needs power. You can't run these data centers on AA batteries.
And that brings us to the second derivative trade, the energy segment. You cannot have AI without massive power consumption. The grid needs to be upgraded or hardened to handle these loads.
And TE sells into the grid.
Big time. Their energy segment sales were up 88%.
88. Okay, wait. That sounds too good to be true. Was that organic?
No, a good catch. A lot of that was because they acquired a company called Richards, which specializes in grid connectivity.
Okay, so that number is inflated by the acquisition.
It is. But, and this is key, if you strip out the acquisition, organic growth was still 15%.
15%. For a utility-focused business, which is usually as sleepy as it gets, that's fantastic.
It confirms the thesis that utilities in the U.S. and Europe are in panic mode to upgrade their infrastructure.
It sounds like they are firing on all cylinders. But we haven't talked about their biggest legacy business yet. Cars, transportation.
This is where the friction is. This is a part of the report that likely gave investors pause.
Because nobody's buying cars right now, right?
Yeah.
Interest rates are high, prices are high. I feel like I read every day about a new auto plant shutting down.
Exactly. Global auto production is flat to down. If you are a supplier to the auto industry, your revenue should be shrinking.
But TE's automotive sales were up 7% organically.
Yes.
How do you grow 7% when the market you sell to is shrinking? That math doesn't work unless...
Unless you are selling more stuff into every single car. This is the content growth thesis. It is the electronification of the vehicle.
Explain that.
Think about a car from 10 years ago versus a car today. Even a gas-powered car today is basically a rolling computer. It has lane assist sensors, backup cameras, massive infotainment screens, heated seats.
And every single one of those features needs power and data.
Which means more connectors, more sensors, more copper.
So even if Ford sells fewer F-150s, TE sells more dollars worth of parts per F-150.
Precisely. They are outrunning the underlying market because the TE content per vehicle is skyrocketing. And obviously, EVs use even more high-voltage connectors, which helps.
What about the trucks, commercial transportation?
That was a mixed bag. Up 16% organic overall, which sounds great, but there's a massive divergence. Asia and Europe are recovering fast. But the North American truck market, still negative. We are still in a freight recession in the U.S.
That feels like a warning sign for the broader economy, doesn't it? If we aren't moving goods, the economy isn't moving.
It is definitely a macro headwind they have to fight against. If that U.S. truck market doesn't turn around soon, it puts a lot of pressure on the AI and auto segments to carry the load.
I want to circle back to something that really confused me in the report. They announced record orders, $5.1 billion in orders.
Right, and a book-to-bill ratio of 1.1.
Let's pause and define that, book-to-bill.
It's a ratio of orders received, booked versus products shipped and paid for billed. A ratio of 1.0 means you are replacing every dollar of revenue with a dollar of new orders.
And anything above 1.0 means your backlog is growing, so demand is higher than supply.
Exactly. And 1.1 is very healthy.
Okay, so they have $5.1 billion in orders, but their guidance for next quarter revenue is only $4.7 billion. Where is the missing $400 million? Why aren't they shipping it? Why leave money on the table?
That is the multi-billion-dollar question.
Yeah.
And it's the reason the stock looked a bit soft on the guidance. There are two factors causing this disconnect. First, there is AI latency.
Latency, like lag.
In a way, the hyperscalers, Google, Microsoft, are placing massive orders now for data centers that won't be turned on until the back half of 2026 or even 2027. They want to lock in the supply.
So TE books the order today, but they can't recognize the revenue until they actually ship the product months from now?
Correct. So the order book is swelling, but the revenue recognition is delayed. It creates a backlog. The second factor is good old-fashioned seasonality.
In auto.
In auto. We are heading into Q2. Historically, global auto production drops by roughly 3 million units sequentially from Q1 to Q2. It's just how the car factories run. Holidays, Chinese New Year, scheduled maintenance.
The factories shut down for weeks at a time.
Right. So TE faces a sequential headwind in their biggest segment, transportation, which masks the sequential growth in the industrial and AI segments.
So the guidance looks flat or soft sequentially, but it is really just reflecting the factory schedules of Toyota and Volkswagen.
Precisely. But the market can be short-sighted. Algorithms see flat revenue guidance and sell. Humans see record backlog and hold. That's the tension we saw in the price action today.
There was one other risk factor mentioned on the call that we need to address. Inflation, specifically metals.
Gold, copper, silver. The prices have, to quote the call, exploded.
And TE buys a lot of metal. It is their largest purchase category.
They're basically in the business of shaping copper and plating it with gold.
Logic suggests that if your main ingredient gets more expensive, your profits should go down. But we just said their margins went up by 180 basis points. How is that possible? Is there a lag?
Management claims it's all about pricing power. They said they have the agility to pass these costs through to the customer.
But isn't there a limit to that? At some point, doesn't the customer say no?
In a normal market, yes. But look who their customers are right now.
Yeah.
Hyperscalers building AI data centers. They are in an arms race. They have infinite budgets. Do you think Microsoft cares if a connector costs $1.50 instead of $1?
No. They care if the data center opens on time. And the utilities are the same way, I imagine.
Same thing. If the grid goes down, it's a catastrophe. They will pay the premium. So TE is in a unique position where they can pass the hot potato of inflation to their customers without losing volume.
But there is a risk of a lag, right?
Yes. If copper rips higher tomorrow, it takes time to adjust the price lists. So there is a risk that margins could get squeezed for a quarter or two while they catch up. It requires a delicate dance.
So bring this back to the investor context. We have a stock that is down today, but the fundamentals, AI growth, margin expansion, record orders look pristine.
The fundamentals are great. The valuation is the tricky part. We are witnessing a pivot. For a decade, it was a cyclical industrial stock. Now they are arguing they're a secular growth story.
And secular growth stocks get higher multiples. They get to trade at 25 or 30 times earnings, not 15.
Exactly. They are proving they can grow earnings 30% on single-digit revenue growth. That deserves a higher multiple.
Yeah.
But the market has already given them that multiple over the last 12 months.
That's the 55% run-up.
Right. The re-rating trade is done. Now, TE has to execute. They have to prove that the AI growth is sustainable and not just a bubble.
Yeah.
The 1% drop today signals that investors are saying, okay, we believe you. Now show us you can do it again next quarter.
So what are you watching for in Q2?
I am watching that book-to-bill ratio.
Okay.
Can they keep it above 1.0 even as the auto cycle softens? And I'm watching that CapEx. 6% of sales is high for them. If free cash flow takes a hit because they are spending too much on factories, investors might get jittery.
It feels like a classic conflict between the long-term story and the short-term tape.
It is. The long-term story is electrification of everything. The short-term tape is overbought and needing a breather.
All right, let's pivot ourselves. It is time for our favorite segment. We have looked at the past, we have looked at the present, now let's look at the future with a trade idea that is absolutely, positively.
Not financial advice.
Disclaimer time. We are not financial advisors. We are just two voices in your headphones. Do not sue us. Do your own diligence. This is for entertainment purposes only. Do not bet your mortgage on this.
Please don't. All right, hit me. What is the pitch?
I call this trade the heavy metal arbitrage.
Sounds loud.
Yeah.
Risky.
It is a little loud. Here is the thesis. TE connectivity is effectively a short position on copper and a long position on pricing power.
Go on.
The market is terrified of metals inflation. We just talked about it. Copper and gold are rising. The standard logic is that this kills industrial margins.
Input costs go up, profits go down. That is Econ 101.
But TE just proved Econ 101 wrong. They expanded margins while metals exploded. They have pricing power because their customers, AI and grid, are desperate.
Okay, so they are inflation resistant.
Exactly. So here's the trade. You go long TE connectivity, TLL, and simultaneously you go short a basket of junior copper miners or a raw copper ETC.
That is aggressive. You are hedging the AI infrastructure build-out against the commodity supercycle.
Think about the logic. Scenario A, copper prices crash. What happens?
TE's input costs vanish. Their margins go to the moon because they won't lower their prices as fast as the commodity drops. You win on the long.
And you win on the short because the copper miners crash.
Exactly. Scenario B, copper prices soar.
This is the dangerous one.
If copper soars, the junior miners might pop, sure, so your short position hurts. But remember the windfall taxes, the operational drag, the geopolitical risks that miners face. Meanwhile, TE just passes the cost to Microsoft and Google.
No, the hyperscalers don't care. So TE stock keeps going up because their earnings keep growing.
So you are betting that TE's ability to pass on costs is stronger than the miner's ability to extract profit from the ground.
It is a heads I win, tails the utility company loses trade. You are effectively using TE as a shield against inflation. It is outrageous. It ignores about a dozen macro risks, currency risks, and the fact that shorting a commodity in a supercycle is terrifying.
But logically, it holds water. If you truly believe in their pricing power, it works.
That is why we are here. We find the angles nobody else is looking at.
Just don't blame us when copper goes to $10 a pound.
Fair enough. All right, let's wrap this up. Recap time.
TE, connectivity, beats big on earnings, raises the AI guide, shows massive margin expansion despite inflation.
And the market sells it off because the stock ran too hot too fast. It's a valuation reset, not a business failure.
Exactly.
Final thought for the listener.
We live in a market that is obsessed with the brains of the operation. Everyone's watching NVIDIA, everyone's watching the GPUs, the software, the LLMs, but do not ignore the nervous system.
The nervous system.
The connectors, the sensors.
Yeah.
If the data center burns down because of a faulty connector, the GPU doesn't matter. If the power grid fries because it can't handle the load, the AI doesn't run.
TE keeps the lights on and the data flowing.
It's the plumbing.
The plumbing matters.
The plumbing always matters.
Keep your eyes on the tape. We will see you next time on Talk Tickers.